Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this episode, I want to get into, we're in September of 2024. I want to get into this idea that we should expect a bit more market volatility. There are a lot of forces at work. Many of them are positive, have been positive, but we're starting to see a few more negative forces at work. In some ways, maybe think of it in terms of catalysts on the market, things that could drive the market lower or things that could drive the market higher. So we're sort of entering in this period of uncertainty as we march towards the end of the year here in 2024. So I just want to kind of get into that and frame it up and help us all hopefully understand it a little bit better in terms of what's happening and where things could go. So let's start with AI optimism. That's been one of the key drivers of performance in the equity market, positive performance last year and this year. And one of the metrics we've been tracking is that Magnificent Seven index, in this case from Bloomberg, which is up just over 30%, so call it 31% year to date as of this recording. And as we recently talked about, a number of these stocks have deployed a lot of money in CapEx spending, so capital expenditures in the second quarter even, really focused on data centers and artificial intelligence. And so all of that seems very positive, but we've seen that index kind of reverse since the beginning of July. And part of that is driven by investors saying, hey, wait a minute. So we're investing a lot, but what does that mean for revenues? What does that mean for earnings? What does it mean for me as a shareholder, and when am I going to see those results? So think of it as a little bit of optimism and almost euphoria around the concept. Now people are turning their attention to execution, basically, and hey, when's this stuff going to get done, and when am I going to see it in my earnings and my dividend payments, whatever it might be. So that's sort of a tension, and to the degree that companies in some form disappoint, that could be a downward catalyst, if you will, on equity moves, especially the cap-weighted S&P 500 that is so dominated by the Magnificent Seven stocks. So anyway, that's one sort of balance, right? The AI optimism, but at the same time, sort of a show-me attitude from investors. And another sort of factor has been the economy. The economy, the kind of the punchline is, grew much more firmly, much better than expected in the first half of the year. And so the most notable was basically GDP in the second quarter, annualized GDP at 3%. And yet what we're seeing is even a consensus estimate for the economy to slow down. Right now, the annualized numbers for the third and fourth quarter are 1.7 and 1.4% respectively, but we wouldn't be surprised if those numbers come down. And for example, so some of the things that investors track are called purchasing managers indexes. So PMIs, these are basically indexes drawn from surveys of business leaders, and they tend to break it between services and manufacturing. But for whatever reason, manufacturing often is sort of a leading indicator on the economy. And the manufacturing PMIs from both S&P Global and the Institute, the Institute for Supply Management, those PMIs for manufacturing came in at 47.9 and 47.2 respectively. And so just to remind ourselves, the level 50 is considered neutral, and anything below 50 is signaling that segment, in this case manufacturing, is contracting. So those are sort of negative numbers that have had people's attention. It's caused some sort of near-term negative volatility in the equity market because people are worried about a slowdown. So as we watch what's happening and there's more data signaling a slowdown, that sort of spooks investors. Anyway, on a related note then to the jobs market, it's been very, very, very firm in the wake of all the support from the pandemic and the pandemic reopening. But we're all watching as the labor market softens relative to that. So for example, the job openings and labor turnover survey, what's called the JOLTS report, came out recently showing that the number of jobs open fell to 7.7 million in July. And that was below the forecast of 8.1 million. Now, this is the lowest level since January of 2021, but I'll acknowledge it's above the levels since before the pandemic. So think of it as a strong labor market that's easing. Some people are using the word normalizing, and another metric that we track basically is the number of people looking for work divided by the number of job openings. And that number has fallen to 1.07. And that has been elevated. I think it got up above 2. So think of it as there's now about one, in round numbers, about one job available for every person looking for work. And again, we expect that number to even fall further. So anyway, think of it as a softening job market. And to the degree that that gets worse, that's going to spook investors. Next up, I would say, is geopolitical unrest. And obviously, these wars, Russia, Ukraine, and Israel, Hamas, they're horrible situations in terms of the human impact, the human cost of what's going on. And I would say escalation is the key risk in focus, right? People are worried, for example, about Iran getting more actively involved in coming after Israel. And that can sort of shake people up, sort of increase nerves. It dampens what's called animal spirits. But I will say, one of the things we've noticed is just these little drips of signaling that parties may be headed to the table for basically peace negotiations. So I think ceasefire and peace, those are both things that everyone wants, right, at the end of the day. And so the question is there a path forward? And a lot of times when you're in a war or observing a war, it feels like it's never going to end. But the reality is they almost always do, and they do through peace negotiations. So we wouldn't be surprised to see some relief related to sort of unanticipated peace in one form or another in these different hotspots. So that's another thing we're watching. Now, as it relates to our election, just speaking very generally, on average, equity market volatility jumps during a presidential election in the month up to and the month of the election. So October and November, the actual metric VIX, the VIX index, which measures stock market volatility, is on average 20% higher in the years where we have a presidential election compared to the other years. So just as investors, we should sort of gear up as we head into October and November for uncertainty, and for uncertainty to lead to a higher level of volatility as people try to process what's going on. Now, the punchline here, it's interesting to me, is if we have a really close presidential election, and especially if we have one where it feels like that it's being contested in one way or another, which we know happens, that could really sort of shake people. That could be a negative force. The flip side of that is if we have a clear winner, and I wouldn't even say which party, I don't know that it really matters. If we have a clear winner, a decisive victory in November as it relates to the presidential election, for all that's been going on and for the experience of the last couple of elections, that would actually be a pretty calming effect, I think, on the markets to have at least clarity going forward on directionally where we're headed. Now, next up, speaking of the federal government, is the Fed itself. And so Fed officials are signaling, they've been signaling that they're going to cut rates in September. Markets are trying to decide whether it's a quarter point cut. Last I looked, it was round numbers of about a 40% probability based on Fed funds futures, or a half point cut, 50 basis points. And it's basically, and actually it's the other way around. It's 60% probability of a quarter point cut, round numbers, 40% probability of a half point cut. But either way, that's what the market's expecting. So what does that mean in terms of market direction? Well, if let's say that all of a sudden we look, and I think we've got a CPI and a PPI coming out, so inflation readings, and they come out and they pop up, and they kind of bring into question the Fed's ability to cut rates. That would be sort of destabilizing for the market. That would be viewed negatively. On the flip side, if inflation stays cool, and then more importantly, if the Fed acts in a way, and especially if they act decisively and then they're communicating decisively, hey, we're going to have more cuts, market's going to probably like that. And so anyway, this next Fed meeting, I think it's the third week of September, basically it's an important meeting. Everybody be watching it. Now, a final thing I'll mention is earnings growth and market levels. So when we look at price earnings ratio, that classic metric for valuation against the S&P 500, its traditional form, which is cap weighted, meaning bigger companies influence more, that sits at about an 18% premium to the 10-year average PE. And so that, people will call that a richly valued market. That means it's going to reflect a little bit more downward sensitivity. So think of it as bad news brings the market down a little bit more quickly when things are richly valued. Now, I will point out the equal weighted S&P 500, we've been talking a lot about this, is actually about in line with its average. So what that means is those bigger tech-oriented companies are the drivers of this PE expansion. We've seen them roll over and post a negative return since the, I think, second week of July. And so again, I think the spirit of it is a diversified portfolio in this environment is likely going to hold up better. But we have to be mindful that overall, by traditional metrics, the market's a little bit richly valued. And to the degree either earnings disappoints or the Fed doesn't cut or we see worries about employment and the economy, it just creates a sense of a little more sensitivity in terms of equity investors. And so some potential for sort of volatility and potential declines. So anyway, think of this as we come after the holiday and we head into September, we sort of are staring down roughly 4 months towards the end of the year. We really wanted to cover all this to sort of set ourselves up and be ready for some drama, basically some market volatility that'll probably be increased, and then the potential for a breakout move. But as we've discussed, there's definitely forces that could cause negative moves, but there are also forces that could cause positive moves. So we kind of just have to be ready for, as long-term investors, for this kind of volatility. Anyway, thanks very much for listening to this episode, and we'll catch you on the next one. Take care.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.